Hey guys, what's going on? It's Billy here from the best place to buy gold online. I hope you're having a fantastic day. So in today's video, I just want to show you this gold chart that has central banks extremely worried. So before I start and get into this article, I just want to say that I do disagree with what this guy has written at the start of it with regards to what he believes gold to be. He says it's an investment, and he's got a bit of a beef with Jim Rickards when Jim Rickards kind of says, that gold is money. And gold is gold, whatever gold is, it's not going to change. A gram of gold today is still going to be a gram of gold tomorrow, 5 years down the line, whatever. Some people believe it's an investment, some people believe it's money. I just don't agree with alienating a lot of people that are going to read good quality content like this by having some beef with Jim Rickards and other analysts who say that gold is money. When you look at what Jim Rickards writes, especially in his new book, The New Case for Gold, and he delves into it, the way he writes that book and gives the information in that book, he's given it to the general populace. And what I found with the general populace is that if you go to academic with it, go to economist with it, so to speak, you kind of lose people. So you need to keep it simple, and Jim Rickards keeps it very, very simple. At the end of the day, an investment, if you look at the definition, an investment is something that returns a yield or a profit, or a dividend. And yes, in a way, gold will turn a profit, but when you look at it, obviously in monetary terms, in currency terms, I understand where this guy is coming from, because currencies and fiat currencies are not going to exist. So you need to look at gold as in real value and what it can buy. But at the end of the day, it is money. So again, that's the only disagreement. But I'm rambling on now, so I'm just going to delve into this and get on with this article. So I'm not going to read it all, but it's very, very fascinating, very interesting that he talks about this chart here. And it's the world physical gold and the central bank demand. So from 2000 to 2007, there was 38 million ounces. So as he put here, the total physical gold and central bank demand was 30 million ounces of 2000 to 2007 versus the 390 million ounces during the 2008 and 2015. So he goes on to say, obviously, note that these figures do not include the ETF or similar product demand. He decided to exclude this data because obviously it's impossible to know if the gold held by these electronic traded funds is actually oversubscribed or not. With one owner claiming more, one or more owners claiming the same amounts of gold. So, but see, while obviously this is a big change to central banks' net sales. That obviously, even though the central banks still hold 235 metric tons of gold in 2008 and 34 metric tons in 2009, this changed to net purchases in 2009. If we add up all the central bank gold sales and purchases from 2008 and 2015, it turned out to be 2,657 metric tons. While this was a big change from the central bank net sales of 3,956 metric tons, the real winner was the increase in the gold and the coin demand within the private market. And obviously the gold and bar and coin demand surged from 9,461 metric tons to 2,657 metric tons during obviously from 2008 to 2015, and then obviously 2,657, that's where it rose to during 2000 and 2007. Thus, the physical gold investment and central bank demand totaled a whopping 12,118 metric tons. This equals a massive 390 million ounce for total physical gold and central bank demand since 2008, compared to the net supply of 38 million ounces in the first period. He goes on to say, yes, he said, if Western gold ETF demand rally starts to surge, this could obviously cause a serious trouble for central banks as availability of the gold supply tightens and squeezes gold supply and gold ETF demand hit a high of 645 metric tons in 2009, and the US world stock markets crashed to their lows. However, we already saw a huge 364 metric ton inflow of gold ETFs during the first quarter of this year, and the Dow only fell 2,000 points. So what happens when the market really starts to tank? So if gold ETF demand jumps to 1,000 metric tons, along with gold bar coin demand and central bank purchases totaling 2,000 metric tons, this would equate to 3,000 metric tons, or nearly 75% of the total supply. So you're really going to start to see a squeeze in the demand in the actual being able to physically get hold of this gold. And so, at some point, demand for the gold will overwhelm the supply, and it will just cause the price to skyrocket through the roof. So there you have it. It's an interesting report. I'll leave a link in the description below. Love to hear your thoughts on it. Drop them in the comments section and below. And if you've got value from this, free to like, comment, share. And if you haven't done so already, go ahead and check out my website, goldfinancial.de. Go ahead and enter your name and email over there to grab yourself a free report on why now is the right time to buy gold and why you should be buying gold through Legacy Gold. And I'll see you next video. Take care.